Investors live in fear of market crashes. So in this video, I look at the likelihood of a crash, how long they last, and whether valuations affect the probability of crashes happening in the first place. I also discuss how likely a crash is at the moment and what you can do to help protect your investments against one. This video is sponsored by Incogni, an app that helps you take back control of your data privacy. So how likely is a market crash? I think it's important to define what we mean by a crash, and there are certain definitions about market pullbacks. For example, a 10% fall from the previous all-time high, that's called a correction. A 20% fall would be a bear market, and although it's not a formal definition, let's say that a market crash is 30%. You also have to specify the period over which that crash happens. And that's because we'll be looking at the probability of a fall of that size. And the time period over which we're looking makes a big difference, as we'll see later. Also, let me point out that the purpose of this video is not to scare you. In fact, it's the exact opposite. Market crashes are fairly rare, and when they do occur, they tend to be fairly short-lived. So how long do they actually last? Well, here's that S&P graph that you've seen so often going back to 1871. This is data from Robert Shiller, and this is total real return, inflation adjusted and with dividends reinvested. The top panel shows you the S&P total return data. I've also highlighted times when the market fell back from its all-time high up to that point in time. Now you can see immediately that the S&P and other stock market indices spend a lot of their time pushing new all-time highs. But of course, there are the inevitable pullbacks. So how long do those last, and how long does it take the index to get back up to its previous all-time high? Well, what I show in the bottom panel is the fall from the previous all-time high as a percentage. And over this 150-year period, I've shown the 6 periods with the longest recovery times. So that's from the day that the market falls from its previous all-time high to the point at which it recovers its all-time high and then exceeds it. Now the longest period was a recent one. That was 12.7 years, and that was the double crisis of the dot-com bubble imploding and the global financial crisis. Both of those lasted about 6 or 7 years. Just as we'd recovered from the dot-com bubble, the global financial crisis hit. The next longest period was just under 12 years, and that was the period in the 1970s when inflation in the US was very high, there were lots of energy crises, and there were recessions that went with those. So that was a particularly difficult time for the US stock market. And both of those very lengthy drawdowns for the S&P 500 were very deep as well. They both suffered a peak-to-trough fall of about 50%. The other kind of thing which causes a crisis in markets is a war, a global war. And World War I and World War II both came with their own drawdowns. The one for World War I was about 8 years, and so was the one for World War II. And again, both of those suffered peak-to-trough falls of about 50%. Then we've got arguably the worst fall in the US stock market. That was during the Great Depression, and that was another 7-year recovery time. What marks out that crisis was a very deep peak-to-trough fall. The S&P fell by over 70%. In fact, the fall was almost 80%. But before we get locked into this mindset of it's all doom and gloom, remember that most of these falls are very, very short. That means that if you sell at the first sign of trouble, it's probably not going to work well for you. In fact, if we work out the median time, that's the typical time that the S&P spends below its all-time high before it recovers that all-time high, it's 61 days, just 2 months. So if you do sell when there's little wobble, there's no way to know whether that little wobble will turn into a fully fledged crash. Chances are it won't. And that means you'll be locked out of markets, they'll snap back very quickly, and you'll be thinking, how do I get back into this market at a higher price? So don't get discouraged by these long periods in the past when markets didn't recover. Be aware of them by all means, but they are rare. Maybe the way to think about this is like the risk of driving your car. If you always focus on the worst possible outcome, which is death on the roads, then you'd never get into your car. But all of us do. We get into our car and we drive around. And that's because we know that the statistics are pretty good. It's unlikely that you're going to suffer a really bad accident just driving to the supermarket. An investment is much the same. Focus on the typical case, the likely cases, but be aware of the risks and how to mitigate them. Today's video is sponsored by Incogni, an app that lets you take back control of your personal data. You may not be aware that data brokers can legally collect information about you and then sell that to third parties. What kind of information can they collect? Well, it would be things like your name, your address, maybe your health details, where you hang out, anything where you've left a digital footprint. In theory, they could collect that information and sell it on to anyone. So what can the data be used for? Well, say for example that you're buying a financial product, taking out a loan, opening up a mortgage. It could be that some of that data is used in order to assess your risk. Or perhaps they could use it for advertising. If they're trying to cold call you, they could use this information in order to figure out what it is you're likely to buy. And of course, those are reputable companies buying your data. Hackers could buy it too. So what Incogni allows you to do is to contact multiple data brokers to tell them that they can't use your data. I set up my Incogni account in January of 2024. And as I make this video in May of 2024, you can see that they've sent out 45 requests to separate data brokers, and 40 of those requests have been completed. Here's my dashboard so you can see that progress over time. If we look at the detailed view, what you can also do is sort by severity score. So if I just look for high severity, you can see, for example, that full contact is now not able to use my data. Furthermore, in 21 days, Incogni will contact this broker again to ensure that that request stays in place. And for each of these brokers, you can see the associated risks. So for full contact, it's identity theft, spam mail, data leaks, targeted advertising, and so on. Now, for viewers of PensionCraft, there's a special discount from Incogni such that you'll get 60% off your annual subscription if you go to incogni.com/pension. Or you can just go to the link in the description below. And that subscription comes with a 30-day money-back guarantee. So now let me share a rule I've come up with, which I think helps people remember what the stats are for a market crash. And I call this the 2-6-16 rule. So remember our classification system for market pullbacks. A correction is a pullback of 10%, a bear market is 20%, and we've said that a crash is 30%. We also have to specify the period over which that crash will occur in order to work out the probability. So what we can do is go back in time and count for every 12-month period, say, what's the probability in what percentage of cases was the fall in the S&P 500 10% or more, 20% or more, or 30% or more. And that's where we come up with these probabilities. The most extreme fall, 30% or more, only occurs with a probability of 2%, and that's very low. A bear market is more likely. There the probability is 3 times higher, it's 6%, and for a 10% fall, well, they happen all the time. So the probability of that is 16%. Now, I mentioned the period of time is critical here. How about if we extend that period to 2 years and all the way out to, say, 20 years? Well, what we see is that there's a gradual reduction of the probability of a crash the further out we look in time. The only exception is for the 30% or greater fall. And there, if we look at a 2-year period, the probability roughly doubles from 2% to 4%. Why is that? Well, it's just more likely that there's going to be an accident. But over that kind of short period of time, the upward drift of markets is unlikely to help you. Whereas as you extend that period of time, the probability gradually falls beyond 2 years until it falls to 0 after 15 years. And with the 20-year horizon, it's never been the case that the US market has fallen, at least according to Robert Shiller's data. So this is why if you need money in the next 5 years, say, you'd be unlikely to put it all into the stock market because it is crashy. This probability of, say, 3% of a 30% fall is unacceptable if you're paying for your children's college, for a holiday, for a present. So equity just doesn't work over short periods of time with any kind of certainty. In that case, you want to go for something much safer, a cash account or maybe a money market fund. Or you could go for single government bonds. Now let's consider how valuations affect those probabilities. Now at the moment, people often tell me that they're scared to allocate to global markets because US valuations are so high. They fear that that's going to cause a greater probability of a crash, or at least a correction. So let's see what the evidence is behind that. Firstly, let's look at the valuation measure I'm using, which in this case is Robert Shiller's excess cape yield. This is a valuation measure which adjusts for the real rate of interest. When the real rate of interest is low, then people have to take more risk. They move money into risky assets like stocks, and that pushes up valuations. So this measure corrects for that increased risk appetite when rates are low. And on the graph beside me here, when we're above the median expensiveness of the S&P, it's shaded in red, and that's the lower part of the graph. So expensive is down, cheap is up, and that's shaded blue. And there are no prizes for guessing where we are right now. Yes, the US market's expensive. In fact, if we think of it in terms of probabilities, the US market's been cheaper about 79% of the time since 1870. So notice the dashed lines on this graph. Those are the 25th and 75th percentiles of cheapness and expensiveness. So let's say we start off at the 75th percentile when US stocks are cheap. In that case, the crash probabilities decrease. Instead of 2, 6, 16, we're talking about 1, 5, 13. All of the probabilities of crashes from all levels of extremity have reduced. In contrast, if we look at the times when US stocks are expensive, that's the 25th percentile, all of the probabilities of a crash increase. So instead of 2, 6, 16, we're talking about 6, 20, 39, and the probability of a correction has doubled. So there is a clear effect that you can see here of valuation on the probability of a crash. So what does that mean for the probability of a crash right now? Well, given that we're very close to that 25th percentile, we're actually at the 21st percentile. If we round the probabilities, it's the same as that 25th percentile. So a correction happens with a probability of 39% over the coming year. A bear market has a probability of 20%, and the probability of a crash, that's a 30% or greater fall, is 6%. So still quite low in absolute terms, but still higher than it would have been if valuations weren't so high. So how can we mitigate this risk? Does diversification help? Now here I'm going to switch to a different data set, and this allows me to compare different countries but also different regions, and this is data from MSCI. So all of these data are in US dollar terms, and also they're not total return data and they're not real data. They're not inflation adjusted, and dividends aren't reinvested. Now the data start here in 1970, and if we look at the US, for example, it's close to the 2-6-16 rule. It's the 2-5-13 rule. How about if we look at MSCI World? That's just developed markets, and that's often dominated by the US anyway. So it's not altogether surprising that that doesn't change the probabilities at all. It's still 2-5-13. Now if we do look at individual countries, quite a few of them are considerably worse than the US. The UK, for example, would be 3-7-19. So a fall is more likely whatever its severity, but not by a huge degree. What's kind of interesting here is that diversification doesn't help that much. And that's because stocks tend to be highly correlated with one another. If a market falls, particularly the US market, it tends to drag down the entire global equity market with it. That's not to say that diversification across equity makes no sense, far from it. If we look at the Ulcer Index, which is a measure of the depth but also the length of crashes. So a high Ulcer Index means that you worry a lot because the crashes tend to be deep and long. What you can see is that single countries tend to have quite a high Ulcer Index. In particular, Spain, Italy, Hong Kong, and the UK have a much higher Ulcer Index than, say, a global index. Or if we look at the best countries in terms of Ulcer Index, the US scores very well, and in fact Switzerland comes out best with the lowest Ulcer Index. So diversifying across different equity markets doesn't really offer you much crash protection. It mitigates the ulcers, but it won't stop a crash altogether. Because when things get really scary, stocks don't really offer a hiding place anywhere. So to truly diversify when things get really bad, you need to move to something like a money market fund or maybe short-term government bonds. or perhaps cash, and another thing to look at might be gold. So if we do compare the ULSA index on something like a money market fund in the UK, it's almost zero. As you can see here, it's 0.02 for this legal and general fund. Compare that with a developed market index like MSCI World, and that's got an ULSA index of 17%. But of course, over the long term, you pay the price for that safety. If you're going to invest long term, money market funds generate much smaller returns than equity markets. And that's why it's a risk premium. You're paid a premium to put your capital at risk. So as I said at the beginning, I'm not trying to scare you here with these probabilities. I'm just trying to show you what those risks are. Hopefully that's reassured you rather than scared you. But if you are scared of a market pullback, remember you can always diversify across different asset types. And the time to do that is before a crash happens, not after. Now don't forget our offer from Incogni. This allows you to take back control of your personal data, and you can use the code PENSION in the link below. You'll also find that link in the description, and that will give you 60% off your annual plan. And, as always, thank you for listening.